Assalamualaikum warahmatullahi wabarakatuh. We are from Group 1 from AC1105G. This is our video presentation about financial management strategies for small and medium enterprise. This video is prepared for Madam Sabaria binti Jamaluddin. First, let us introduce ourselves.
Hi, my name is Nurhazwani binti SAMSUDIN. My matrix number is 2022474164.
My name is NORDAYINI binti NASIR and my matrix number is 2022880592.
My name is NURUL ISMAHANI binti ABDUL and my student ID is 2022614508.
My name is ATIKAH binti Muhammad SAIFUL AZLAN and my matrix number is 2022871726.
My name is SAFIYQA binti SAFRAN and my matrix number is 2022848774. Small and medium-sized enterprises, or SMEs, are the backbone of economies worldwide. They play a vital role in driving economic growth, fostering innovation, and creating jobs. The definition of SMEs varies globally. For example, in Malaysia, manufacturing SMEs are defined as firms with a sales turnover not exceeding 50 million ringgit or fewer than 200 employees, while in the service sector, the threshold is 20 million ringgit in turnover or 75 employees. In countries like the United States, SMEs are typically defined by the number of employees, often between 10 and 100. Despite these differences in classification, SMEs are essential to both developed and emerging economies, contributing significantly to GDP, innovation, and job creation. However, SMEs often face challenges in financial management. To thrive, it's crucial for these businesses to adopt effective financial strategies that ensure long-term success and stability.
Small and medium-sized enterprises play a crucial role in any national economy, contributing to economic growth, employment creation, and innovation. However, these businesses often face challenges in managing their finance effectively. One of the challenges faced by SMEs is limited access to external financing. The reason why is because they lack sufficient collateral requirements, making them a high-risk option for lenders. Even when financing is available, it often comes with high interest rates due to the perceived risk. Without adequate funding, SMEs struggle to invest in technology, expand operation, or improve product quality, leaving them at a disadvantage in competitive markets. Next, lack of financial literacy is also one of the challenges faced by SME. Financial literacy is critical for effective financial management and long-term sustainability. Many SME owners, however, lack the necessary knowledge and skills in areas such as budgeting and forecasting, understanding financial statements, taxation and compliance, and assessing financial tools. The lack of financial literacy often leads to poor decision-making, inefficient resource allocation, and increased vulnerability during economic downturns. Last but not least, SMEs tend to have huge reliance on traditional record-keeping methods. Many SMEs still rely on outdated or manual record-keeping systems such as physical ledgers, spreadsheets, or handwritten records. This creates several issues such as errors and inconsistency, difficulty in analysis, and inadequate transparency. The reliance on traditional record-keeping also makes it difficult for SME to adapt to the digital economy, where financial insights are critical for competitive advantage.
Diversification of financial sources means assessing and utilizing a variety of funding options to meet a business financial needs instead of relying on just one or two sources. The benefit of this strategy is risk reduction. It could reduce dependence on a single financial source. In addition, it also improves cash flow by having multiple funding streams to ensure steady resources. Other than that, it can also help business grow since having access to diverse capital opens growth opportunity. SME can try these three methods in finding other funding stream. The first one is crowdsourcing an unofficial financial system. Crowdsourcing refers to raising funds from a large number of individuals, typically through online platforms. It is often used for specific projects or business ideas. For example, reward-based crowdfunding, where business offer rewards to contributors in exchange for funding. Equity-based crowdfunding, where investors receive equity or shares in the business in return for their investment. Unofficial financial system refers to non-traditional informal networks that provide funding or credit outside regulated financial institutions. For example, money lenders, informal lenders will provide loans, often at higher interest rates. This method is accessible but may pose risks due to lack of regulation. Friends and family, borrowing funds from personal networks. It is a flexible term but may strain relationship if not handled carefully. The second one is traditional banks and government programs. Traditional banks are long-lasting providers of financial services for SMEs, offering loans, credit, and other financial products. For example, trade financing supports import or export activities through instruments like letters of credit and bank guarantees. Equipment financing, loans specifically for purchasing equipment, often with the equipment itself as collateral. The government programs are designed to provide SMEs with financial assistance, incentive, and support to promote entrepreneurship and economic growth. For example, grants and subsidies, non-repairable funds for specific purposes such as R&D, green initiative, or community development, tax benefit and incentive, tax breaks or credits to encourage SMEs to invest in specific areas like technology or energy efficiency. The third method is angel investing and venture capital. Angel investors are wealthy individuals who invest their personal funds into startups or SMEs during the early stages of the business. Key characteristic of angel investing is that the investment amount typically ranges from 10,000 to 500,000 depending on the investors and the business needs. The stage of investment, the early stage businesses or startups that are often pre-revenue or in their initial growth phase. Their focus is more likely to find ideas or businesses with high potential even if risks are higher. The involvement for angels may provide mentorship or advice, but their involvement is usually less intensive than venture capitalists. Venture capital involves funding from professional investment firms that pool money from multiple sources to invest in startups with high growth potential. Their key characteristic is the investment amount ranges from 500,000 to millions, depending on the stage of business. The stage of investment focuses on later stages compared to angel investors, such as scaling and expansion phases. The structure is managed through funds with a clear process for investment, monitoring, and exit strategies. Their involvement is playing an active role, often taking board seats and influencing key business decisions.
The next one is effective cash flow management for small and medium-sized enterprises or SME. Proper cash flow management is vital for keeping business afloat, ensuring it can meet its obligation and positioning it for growth. Cash flow management ensures that business has enough liquidity to meet its financial obligations. This means having sufficient funds on hand to cover everything from operating costs and unforeseen expenses, whether it's a sudden repair, an opportunity for expansion, or an unexpected emergency. Good cash flow management allows business to respond effectively without scrambling for funds or taking an expensive debt. Next, a strong cash flow system ensures that business has enough cash on hand to cover day-to-day expenses. This can include wages, utility bills, supplier payments, and inventory purchases. If the business don't manage the cash flow well, even profitable business can run into trouble, unable to pay bills or employees on time. This creates a ripple effect that can harm your operations and relationships with suppliers and employees. Finally, poor cash flow management can have severe consequences. If business regularly struggles to meet its obligation or pay bills on time, it can seriously damage the reputation and creditworthiness. Suppliers might demand upfront payments, lenders may view the business as risky, and it could even lose customers if services or products are delayed. All of this creates unnecessary stress and jeopardize the growth and stability of your business. Next, we will discuss practical solutions to overcome ineffective cash flow management in small and medium-sized enterprises or SME. Poor cash flow can put business at risk, but with the right strategies in place, you can improve liquidity, reduce financial stress, and set your business up for long-term success. First, let's talk about optimizing payment procedures. One of the most common causes of cash flow problems is delay payments. To combat this, consider setting up automated billing system, offering discounts for early payments, or setting clear payment terms with clients. Having an efficient and transparent payment process ensures that receive funds on time can plan accordingly. Next is bargain for more advantageous terms with suppliers. Instead of paying invoices as soon as they arrive, negotiate extended payment terms. By securing longer repayment periods or favorable pricing, it reduces the immediate cash flow and eases the burden on working capital. Suppliers often appreciate long-term relationships and many are willing to offer flexible terms, especially if the business is a reliable customer. Another key solution is to allocate emergency reserve for unforeseen costs. Unexpected expenses can arise at any time, and without a financial buffer, cash flow could take a hit. Set aside a portion of profits each month into an emergency fund, which can cover sudden repairs, legal issues, or unexpected market changes. This ensures that the business aren't caught off guard when an urgent expenses arises. Effective planning is essential for cash flow management. Regularly assess cash flow forecasts, tracking inflows and outflows. This help business anticipate shortages and plan for slow periods. By understanding cash flow cycles, the business can make better decisions about when to invest, when to save, and when to take precautions. Moreover, making strategic decisions based on solid financial insight is crucial. Before making any big investment or changes, analyze how this decision will impact business cash flow. Will they strain the liquidity or bring in additional revenue? Always weigh the potential risks and rewards, especially when it comes to expansion or new projects. Finally, it's essential to have a solid understanding of financial management concepts. This doesn't mean that there is need to be an accountant, but having a basic grasp of cash flow statements, balance sheet, and profit margins can make a significant difference. Understanding how money moves through the business gives business the tools to make informed decisions and avoid common financial pitfalls.
Effective financial management relies heavily on cost control and expenses management. One essential approach to achieving this is by negotiating better prices with suppliers. To secure favorable pricing, businesses must conduct thorough market research to analyze different suppliers, build solid relationships, and remain flexible in their approach. Understanding the markets allows the company to identify suppliers that offer the best value. When sufficient data is gathered, businesses can proceed with negotiating prices and payment terms. If the supplier is unwilling to lower their prices further, negotiating better payment conditions can be a viable alternative. Additionally, the term of any service or support contracts that come with purchases should also be open for negotiations. Another critical aspect of financial management is identifying and eliminating unnecessary expenses. To effectively do this, businesses must assess their current financial situation by gaining a clear understanding of their financial inflow and outflow. Reviewing income expenses over the past few months can help track spending patterns and pinpoint areas where costs can be reduced. Avoiding impulse purchases is also essential, which involve recognizing spending triggers and emotion cues. By embracing a minimalist mindset and establish a buffer zones between emotion and spending, businesses can avoid unnecessary expenditure by delaying purchases. Implementing cost-saving measures is another important step. Businesses should prioritize essential tools and resources by identifying those critical to operations and consider postponing the purchase of non-essential items. Reducing spending on IT upgrades is another strategy, as such upgrade can be costly. When an upgrade is necessary, businesses should opt for software solutions that perform multiple functions or replace manual processes to enhance efficiency. Regularly reviewing and adjusting pricing strategies is crucial for maintaining profitability and competitiveness. Businesses must determine the right price range and that align with customer expectation while covering operational costs. Factors such as operating costs, supply and demand, and competitive advantage should all be considered while setting prices. Striking the right balance between competitive pricing and value proposition is key to a sustained business success.
Next strategies is investment in technology and automation. First, streamline operation accounting software like QuickBooks, Xero, and Wave can streamline financial management by automating tasks and providing real-time insights. Inventory management system like Just-in-Time, FIFO, or LIFO help businesses track inventory, sales, and orders, minimizing stockouts and overstocking. These tools integrate seamlessly with accounting systems, enhancing profitability and operational efficiency. E-commerce platforms like Shopify, WooCommerce, and Magento offer comprehensive tools for creating and managing online stores, providing valuable insights into customer behavior and purchasing patterns. These platforms also streamline payment processing, enhancing accessibility and customer convenience, and unlocking new growth opportunities in the digital marketplace. Next is increase in efficiency. Automating financial processes such as using cloud-based accounting tools like QuickBooks, Xero, or Zoho Books can improve efficiency and accuracy in business finances. Payroll automation systems like Gusto or ADP streamline payroll management, while expense tracking apps like Expensify automate expense recording and categorization. These tools save time and minimize errors, allowing businesses to focus on strategic growth. Data validation and integration systems like ERP system ensure data flows seamlessly between departments and maintains accuracy, which can reduce human error and incorrect data entry. Transitioning to digital and cloud-based systems such as digital payment platforms and document management systems can improve efficiency and adaptability, and also eliminate traditional methods that use paper-based methods. These tools provide centralized access to documents, reducing costs, improving accuracy, and enhancing operational transparency. This approach supports long-term growth and reliability. Third is planning and investment. SME should prioritize investment based on their core business functions, technology, employee development, market expansion, and sustainability initiatives. Prioritizing these areas ensures optimal returns and alignment with business goals. Evaluating the return on investment (ROI) for every expense is crucial for effective resource allocation and delivering maximum level. Defining clear objectives, estimating total costs, and calculating projected returns using historical data or industry benchmarks help businesses make informed decisions. The ROI formula can be used to quantify these projections. Prioritizing investment with high ROI and shortest payback periods ensure that every money spent contributes to the company's growth and sustainability. Last but not least is reduce costs. SMEs can manage expenses effectively by adopting cost reduction strategies. Automation of routine processes such as bookkeeping, payroll, and inventory management can reduce labor costs and enhance productivity. Building a flexible workforce, hiring freelancers or part-time workers, and equipping current employees with productivity-enhancing tools can also help. Outsourcing accounting services to professional firms or using cloud accounting software can provide expert financial advice without the cost of in-house accounting. Collaborating with other SMEs can also help reduce costs and foster mutual growth. Group purchases, sharing resources like office spaces, equipment, or logistics, and joint marketing campaigns can help SMEs reduce costs and reach a larger audience. By combining these strategies, SMEs can enhance their operational efficiency, reduce costs, and expand their market reach.
The last financial management strategy for small business is risk management. Risk management is a vital financial management strategy for SME to ensure their sustainability and growth. Effective risk management involves anticipating, preparing for, and mitigating potential threats that could harm the business finance, operation, or reputation. First of all, SME should assess and identify potential risks to their business by creating thorough financial prediction and projection. These risks can include economic risk, operational risk, financial risk, regulatory risk, and external risk. To avoid these risks, SME should create thorough financial predictions and projections based on historical data and market analysis. This includes cash flow forecast, break-even analysis, and scenario planning. They can also use risk assessment tools and techniques like SWOT analysis to evaluate vulnerabilities. By anticipating these risks, it will help SME to develop contingency plans and allocate resources effectively to ensure that they are prepared to face the challenges. Next, SME should implement appropriate financial controls. Financial controls are crucial to safeguarding the business asset, maintaining accurate records, and ensuring accountability. They help SME minimize risks related to fraud, mismanagement, or overspending. Financial controls include budgeting and monitoring, segregation of duties to reduce fraud risk, conducting periodic reviews of financial process to identify inefficiency, and monitor expenses to ensure that spending align with the budget. Implementing proper financial controls will improve transparency, reduce wastage, and help SMEs maintain a healthy financial position, enabling them to withstand unexpected challenges. Lastly, SME can grow their clientele by investing in marketing strategies such as social media advertising, email campaign, and local outreach to attract new customers. They can also build customer loyalty through quality service, promotions, and reward programs. Other than that, SME should also expand their product range by introducing complementary products that cater to existing customers' needs. They should also explore seasonal or niche offerings to capitalize on market trends. A broader clientele and diverse product range ensure a steady cash flow and make the business less vulnerable to economic or industry-specific downturns. By integrating risk management into their financial strategy, SME can not only safeguard their operations but also position themselves for long-term success.
That's all from us. Thank you.